Gas remains the pivot point in our discussions about energy policy in the immediate future. Most analysts agree we need gas in our power mix, at least for the next decade or so. The trouble is, gas policy remains possibly the best example of broken politics and broken policy in Australia's rich repertoire of such things. We have an abundance of it, but somehow also a shortage, leaving Industry Minister Madeleine King resorting to verbal warnings to the industry this week that it needs to provide some cheap gas to Australians if it is going to keep getting support.
This one contract will boost Australia's already healthy exports to China by more than 10%. 3 million tonnes of LNG a year.
I think it's a gold medal performance for the resource sector in Australia, and I congratulate everybody in the bid. It is just a terrific outcome for our nation.
23 years ago, the then Prime Minister, John Howard, was exultant about the massive contract signed between the North West Shelf gas partners and China to export huge quantities of liquefied natural gas. But it soon emerged that it wasn't such a good deal.
Well, it was a very good deal for China and for Australian industry and households today. I think most of them would love to get the $3 or $4 gas that the Chinese secured long-term contracts for way back then. So I think that's a good example of just how long Australia has been missing out on the opportunities from selling our gas.
The resource rent tax has allowed the LNG exporters to write down a whole lot of the investment. So I think Australia Inc. has had very little gain from international gas export.
In fact, according to the Treasury in 2023, to date, not a single LNG project has paid any petroleum resource rent tax, and many are not expected to pay significant amounts of PRRT until the 2030s.
The Australian government gets more money from HECS repayments than from the PRRT. To give you an example, Impex, the Japanese gas company that's exported around $54 billion worth of gas out of the Northern Territory, hasn't paid a cent in royalties, hasn't paid a cent in PRRT, and hasn't paid a cent in company tax.
This week, the new Environment Minister, Murray Watt, approved an extension of a processing plant for some of that North West Shelf gas until 2070. It was contentious, both because of the need to protect ancient Indigenous rock art and because it might jeopardise Australia's capacity to cut emissions. A more fundamental question, though, is what the project will actually add to our gas supply or even the national economy.
The Western and Northwestern Australian gas markets are, of course, a very long way from our eastern gas markets. There is no pipeline between them, so they are completely separate markets.
Which makes the Prime Minister's comments this week, linking the North West Shelf with the need for gas on the East Coast to provide so-called firming capacity for renewables, a little confusing. The PM was answering a question on Monday about how he could justify the North West Shelf gas extension given its likely impact on emissions and, therefore, the human misery and environmental chaos being experienced in the floods of recent weeks in New South Wales.
You can't have renewables unless you have firming capacity. Simple as that. And if you look at New South Wales's major user of energy, it's Tomago, there in the Hunter Valley, in this region. It is a major employer there. They're moving to renewables, but they're moving to renewables backed with firming capacity.
Our political class keep telling voters, because we have a shortage of gas, we need to keep approving these projects.
On the West Coast, the North West Shelf partners are obliged to reserve 15% of their gas for the WA market. On the East Coast, there is no obligation to reserve gas for the domestic market, and the demand for gas for the export market has pushed the price of gas higher. The shortfall in gas politicians refer to is on the East Coast.
Essentially, the Queensland coal seam methane gas resource has not turned out to be anywhere as bountiful as was claimed. And so when we add 3 very large LNG export terminals on the East Coast to the East Coast and the South Coast gas demand, and the concentration of gas production and ownership by the LNG exporters, there's a shortfall, and we see that in sustained high prices.
For economists like Bruce Mountain and Richard Dennis, there are solutions to this problem, including a gas reservation policy. It's an idea which got bad press recently when a less than successful proposal was put forward by the Coalition. So how do you get around the criticisms faced by the Coalition?
By starting today. We're still approving new projects that don't have these obligations on them.
Governments need to grapple with quarantining LNG export so that there's more supply in the Australian market. And for successive governments, that's been a step too far.
In fact, both the Coalition's position on a domestic reservation and that of the Greens may give the government a once-in-a-lifetime opportunity to change policy on this issue.
The Liberals went to the election with the statement that we don't have a shortage of gas and a proposal to tax gas exports. The Greens want to tax the gas industry. Industry in Australia, households in Australia want cheaper gas. All Labor have to do is make one group sad, the foreign-owned gas industry. And if they're willing to do that, they can literally provide cheaper gas in a cost of living crisis.
Thanks for watching. If you'd like to keep up to date with all our latest research and work, sign up to our newsletter. Delivered every fortnight, it includes behind-the-scenes updates from Richard Dennis, an exclusive cartoon from Judy Horacek, details for our upcoming events and webinars, as well as explainers, graphs, and not to mention the latest cutting-edge research and analysis from the team here on the key issues that are facing Australia. Click the button on your screen to check it out.